Stocks looking like they're set to attempt a rebound this morning following yesterday's wild market swings. Our first guest says investors should watch out for what she's calling a volatility pothole. Joining us now, Amy Wu Silverman, Managing Director and Head of Derivatives at RBC Capital Markets. Good to see you this morning, Amy.
Great to see you.
I guess one of the questions, once you've seen the market in pullback mode, you see this, what looked like a dramatic reversal higher yesterday. Can we trust what happened yesterday? What are people dealing with in terms of this little uptick in volatility?
I think not much so far. There's been a lot of come to Jesus moments year to date. I think last year, I can't tell you the number of investors who said to me, we think Trump's going to manage the market. The market is a gauge of his success. We've had a reckoning over that. And so everything that happens from now, to me has actually been relatively orderly because there had been hedges in the market. The question is, if we start to get these gap downs or these volatility potholes, as we like to call it, what happens then? Because the truth is there's a lot of strategies right now in the derivatives world that just hinge on the idea that volatility is going to remain suppressed. And I don't know that we can count on that going forward.
Yeah, the strategies you allude to, essentially they're banking on the market continuing to just kind of rotate its way in a smooth fashion, right? So like if certain stocks are down, other ones are up. It suppresses volatility at the index level. You can actually just sort of put on a bet that says that's going to continue. Now, there's been some interruption of that, right? It's been some slippage in that rotation. I guess, how are we to tell whether, we've just experienced a little volatility burst and now we can repair, or if it's going to get worse?
Yeah, I think you'll be able to tell. So it'll look like a August 5th, or it'll look like a February 2018. And, I feel like I've beaten this analogy to death, but we were in kind of this paddling duck market, right? Like the smooth on the surface, little feet rotating underneath. And really all that says is that's saying that correlation is going to remain relatively low. Some stocks are going to zig, others are going to zag, but you get that index suppression, and that's like a nice way to think about shorting volatility. My main concern is this idea that correlation was so low, almost too low, right? Your limbo stick was 12 inches off the ground. It had nowhere to go but up. When that happens, it doesn't happen in an orderly way. It happens in gaps. And so you'll see that pothole, but you won't have very much time for correcting the car, so to speak.
I do see people say, yes, we've seen, the volatility index is up, got to the mid-20s. But credit indicators are not showing a lot of macro stress at this point. You can kind of make the argument that, yes, sure, 5% pullbacks in the S&P happen all the time for any reason or none at all. We're pricing in some economic weakness. Can this just be something that's routine and we recover from?
Look, I think it's possible, and I think, when I speak with investors now, they still haven't gotten a good tone on, do we mean it or do we not mean it, right? Like you think about what Trump said, but then what Howard Lutnick said. And I think there's just this really difficult moment we're in where people have a very difficult time, as it is, pricing kind of administration risk or geopolitical risk. And then you have something that's sort of unprecedented coming through. So that's why there are hedges on. The issue is when you get to certain points, certain levels, where it's not just you're hedging the macroeconomic risk, you're also hedging the idea that there are unwinds happening from trades that have built up over kind of the last 4 years of a very, very high dispersion, low correlation environment. Those volatility potholes, are we prepared for? No, we're not at that point yet. And I think getting there is something that is very difficult to see because it's just very foggy right now when you look at the option tenors.
What does this remind you of? You sound different than you have in a long time. But what does this remind you of if you have to look back at another period in your career watching markets?
Yeah, it's interesting you say that because I do feel that way. And I think that the closest to me is that period of 2017 heading into 2018 where we were almost lulled to some degree into complacency. We had very, very low realized volatility. The correlation environment looked very similar. And when the potholes came, again, it wasn't like you got much warning. And that's fundamentally the issue, right? You can say, look, there are all these risks out there. You should think about hedges. In 2022, we had a market drawdown of 20%. The P-put index, which is a systematic hedging index, also drew down because of the path dependency of the hedges. So even those can break down in certain environments, and that analogy right now is, I guess, what is ticking up the nervousness.
Well, in 2017, we had the uplift from the tax cuts.
Yep.
And then so we had that uplift that was already in play by the time we had tariffs really starting in 2018. This time around, you're getting the bad stuff first. You're getting the medicine without the spoonful of sugar first.
Right.
And so you don't have, we're going to get some tax extension. Hopefully deregulation will start flowing. But it's the bad stuff we're seeing first because that's the easiest.
And maybe that's good. I don't know. And, that's sort of what I'm saying. And, from 2017 to now, the structural change is a lot of hedging has gotten very, very short duration. So it's like you already had a GPS that was like starting to break from a tenor perspective. And now we're over half of all hedging is already kind of one-day options. How is that going to tell you? How is that going to give you that roadmap that we have historically counted on for these potholes? I think, to me, that adds to a layer of uncertainty.
Politically speaking, it's probably better for the Republicans if they take the medicine first and the sugar later, assuming the sugar
in terms of the midterms, absolutely.
See what happens.
You're right.
Yeah, we'll see whether it's
whether it works
whether
or
it's
not.
a plan or whether it just happens that way. We'll see.
Yeah.